As a successful professional, equity compensation can be a significant part of your overall financial picture. But without careful planning, you could miss out on valuable opportunities to minimize your tax burden and maximize your value. In this video, we'll explore smart tax strategies for your equity compensation. Let's start with understanding the four main types of equity compensation. Incentive stock options, or ISOs, offer preferential tax treatment. If you follow specific holding requirements, you can pay taxes at long-term capital gains rates. However, be mindful of the alternative minimum tax implications, as these are often considered the most tax-advantaged form of equity compensation, but they require careful planning to optimize their benefits. Non-qualified stock options, or NSOs, are more straightforward, but don't get the same tax advantages. When you exercise these, the spread between exercise price and fair market value is taxed as ordinary income. While they don't offer the same tax benefits as ISOs, their flexibility can be valuable in overall compensation strategy. Restricted stock units are promises of future stock, usually tied to a vesting schedule. When they vest, their value is taxed as ordinary income. RSUs have become increasingly popular among companies because they provide straightforward value to employees while being easier to account for than the traditional stock options. Employee stock purchase plans lets you buy company stock, often at a discount, through payroll deductions. The tax treatment varies based on how long you hold the shares. With features like look-back provisions, these plans can offer significant value beyond the initial discount. When it comes to stock options, timing is everything. Let's look at the key strategies here. For ISOs, exercising starts your holding period for preferential tax treatment. Consider exercising in years when your regular taxable income is lower, or spread exercises across multiple years to minimize the AMT impact. This is particularly important because the AMT calculation can create a significant tax burden if not properly managed. Keep in mind that while exercising early can start your holding period sooner, it also requires committing capital and taking on market risk. Some companies allow early exercise before vesting. This can start your holding period earlier, but comes with risks. An 83B election must be made within 30 days if you choose this route. This election can be powerful for tax planning, but it's irrevocable, so you need to carefully consider your company's prospects and your own financial situation before making this choice. When RSUs vest, the fair market value is immediately taxable as ordinary income. Most companies will automatically withhold a portion of the shares to cover the taxes due. However, the default withholding rate may not be sufficient, especially if you're in a high tax bracket or subject to state income taxes. Consider adjusting your W-4 or making estimated tax payments to avoid surprises. Companies might offer choices between net settling, where shares are sold for taxes, or cash settling, where you cover taxes from other sources. Each approach has its advantages depending on your situation. Net settling provides simplicity, but reduces your stake in the company, while cash settling maintains your ownership, but requires liquid funds for taxes. For RSU vesting and sales timing, consider your view of the company's prospects and your overall portfolio concentration. While selling immediately provides cash for taxes and reduces concentration risk, holding for at least 1 year after vesting could allow any appreciation in value to be taxed at long-term capital gains tax rates. Most ESPPs allow you to contribute up to 15% of your salary to purchase company stock. Some ESPPs have a look-back provision, where the purchase price is based on the lower of the stock price at the beginning or end of the offering period. For example, let's say your ESPP has a 15% discount and 6-month look-back provision. The stock price at the beginning of the period was $10, but it had risen to $15 by the purchase date. With the look-back, your purchase price would be $8.50, 85% of $10, even though the current price is $15. That's an effective discount of almost 43%. The tax treatment of ESPP shares depends on how long you hold them after purchase. If you hold the shares for at least 1 year from the purchase date and 2 years from the offering date, the sale is considered a qualifying disposition. The discount is taxed as ordinary income, and any additional gain is taxed as long-term capital gains. If you sell before meeting these holding periods, it's a disqualifying disposition. The discount is taxed as ordinary income, and any additional gain is taxed as short-term capital gains. which is typically taxed at the same rates as ordinary income. Let's explore some additional tax deferral strategies that many executives overlook. Consider contributing company stock to tax advantage accounts, where appropriate. This can allow you to defer taxes until retirement, when you might be in a lower tax bracket. However, you gotta be mindful of concentration risk and retirement account contribution limits. Charitable giving can be particularly powerful with appreciated stock. By donating shares directly to charity, you can avoid paying capital gains taxes while still getting a deduction for the full market value. This strategy can be especially effective for shares you've held for more than a year. Tax loss harvesting can generate losses to help offset gains from equity compensation. Be mindful of the wash sale rules, particularly since equity compensation events like RSU vesting could trigger these rules. Here's your comprehensive action plan. Gather all of your equity compensation details, including grant dates, vesting schedules, and expiration dates. Project potential values under different scenarios, considering company growth and market conditions. Evaluate your liquidity needs and tax situation over the next several years. Consider your concentration risk and overall portfolio diversification. Develop a comprehensive exercise and selling strategy that aligns with your financial goals. Monitor and adjust as needed based on changes in your situation or the market. Regular monitoring should include company valuation changes and growth prospects, vesting schedules and upcoming equity events, tax laws that might affect your strategy, your overall financial picture and portfolio balance, changes in your personal financial goals or circumstances. At Range, we understand that equity compensation tax planning is complex and requires ongoing attention. Our team of experts can help you navigate these decisions and integrate them into your broader wealth management strategy. We work with you to create a customized plan that maximizes the value of your equity compensation while managing risk and tax exposure. Visit us at range.com to learn how we can help you maximize the value of your equity and create a comprehensive wealth management strategy that works for your unique situation. Thanks for watching.